Hi everyone, my name is Johnson and welcome to my YouTube channel, and today we are talking about the subject of treasury bonds. Last week we talked about treasury bills, and both treasury bills and treasury bonds are what we refer to as government securities. And before I can talk more about treasury bonds, I want to say what a bond is generally. And a bond is a loan by a lender to a borrower. And I want to say another name for the lender is the investor or the creditor. While another name for the borrower is the debtor or the issuer. And while there are many issuers of bonds, we have two main ones. And these are sovereign governments and what we call companies, stroke corporations. And when companies borrow money for medium-term or long-term reasons, they do so by issuing what we call corporate bonds. And companies will borrow medium-term or long-term for purposes of engaging in value-generating capital projects. And government will borrow medium-term or long-term for purposes of engaging in development projects or infrastructure projects. And some of these projects would be like construction of roads. And I want to say when government borrows for medium-term or long-term reason, they do so using instruments that we call government bonds. And for different jurisdictions or countries, these government bonds come in different names, and for the case of Kenya, which is the interest of our discussion today, we call government bonds treasury bonds. And it's also good to note that government bonds are safer as compared to corporate bonds, because we said government bonds or treasury bonds, for the case of Kenya, are issued by the Kenyan government. When you think of corporate bonds, these are bonds that are issued by corporations. For example, a bond issued by EABL. Then comparing the two, assuming they have similar maturity, or they are both for 5 years, for example, then you would expect that a corporate bond would carry a higher yield or rate of return as compared to the treasury bond. Because we say treasury bonds are backed by the full faith and credit of the government, because we say government has the power to print money or raise taxes just so it can meet its upcoming obligations, and so they have negligible default risk. While for companies could suffer what we call financial difficulties or distress and find themselves in a tight corner where they end up defaulting on their debt. So it's very important for you to know what. If you're looking for safety in bonds, then consider government bonds. If you're looking for high yield and you consider yourself a person who can tolerate high levels of risk, then consider corporate bonds. I would want also to say that treasury bonds in Kenya are issued on a monthly basis. And I want to say that for anyone to become an investor in treasury bonds, you have to have a CDS account with Central Bank of Kenya, which I discussed how to open in my previous video on treasury bills. And if you didn't have a chance to watch it, please visit my website. My YouTube channel, that's Johnson Wanjema, and get to even view other videos that I've already posted. I was saying that for treasury bonds, or I'm saying that for treasury bonds, you need to have a CDS account. And this CDS account should be distinguished from the CDS account that is used for trading shares, which we said is opened with a brokerage firm. This CDS account for trading bonds is open at CBK, and once you have it and you can raise the minimum investment amount for the bonds, which is Kenya shillings 50,000, then you can be able to begin investing. And of importance to note is that the minimum investment amount is 50,000, like I have said, But if you want to do more, you can only do so in multiples of 50,000. That means you can do the minimum of 50,000, you can do 100,000, 150,000, 850,000, 1,050,000. The idea is it has to be in multiples of 50, but you can do like 970 or 135 because investments have to be in multiples of 50, subject to a minimum of 50,000. Another thing to know is that when you are bidding for the bond, then you can either do so as a competitive bidder or a non-competitive bidder. And we say the competitive bidder is one who says the amounts that he wants to lend to the government and then quotes a rate, because maybe they have an opinion of what a good rate is or where rates will be. A non-competitive bidder, on the other hand, is someone who just quotes the amount that he wants to lend to the government, and that amount that they quote is what we call the face value, and then they don't quote a rate because they just want to take the rate as given, which rate they only get to know after the auction results are out. And most of the times the rate is not far away off from the average market rates. So it's a way for those who don't have an opinion of where the rates could be in the near future that they can use to place their bids. Another thing to note is that interest is paid on a semi-annual basis, and that means twice per year. That is after every 6 months. So if you bid for an amount of 100,000 in a bond of 5 years, and the coupon rate, which is the interest rate that is promised to you by the government for lending money to it, that coupon rate is closely tied to the par value, such that if you bid 100,000 at a coupon rate of 10%, then the 10% of 100,000 is 10,000. So you'll be paid an annual interest of 10,000. And because the rate is semi-annual, so you'll be paid twice in a year. That means 5,000 after every 6 months. For example, you'll be paid 5,000 after 6 months, another 5 after another 6 months, and 1 year is gone. Similar payments will follow in the second year, the third year, the fourth year, and the fifth year, upon which time, when your debt matures, then you'll be repaid your principal amount, the one you invested, what we call the par value or the face value. And of course, it's good to also note that maturities in Kenyan Treasury bonds range from 1 year to 30 years, and you can choose whatever maturity you want to invest in. You don't know beforehand what bond for what maturity will be offered. You only get to know when they are put on offer, and so you have a choice to choose which ones you want to invest. Other thing is to note that the interest payment dates are known beforehand. They are predetermined. They are on scheduled dates, including the date of maturity is already known beforehand. They are provided in the offering document or the prospectus. So you can be able to plan for your cash flows well in advance because you know when that cash is coming through. And I want to say that the interest payment you get paid is also subject to what we call withholding tax. And if you hold a bond that is for less than 10 years, you get to pay 15% withholding tax, just like in the case for Treasury bills. But if you have a bond that has a maturity of 10 years and above, then you only pay 10% as withholding tax on your interest income. It's also good to note that we have a special type of Treasury bonds we call infrastructure bonds. And these are bonds that are earmarked for a specific infrastructure project. And one of the advantage is that they are tax exempt, and this makes them very popular and attractive to many investors, because who wouldn't want to get tax exemption? So that's it for Treasury infrastructure bonds. You can include them in your portfolio. You can as well participate in taxable bonds and include them in your portfolio. The idea is there are some advantages that will flow from including having bonds in your portfolio. And one of the advantages is what I've said. You get regular cash flows. You know when the cash flows are coming through. You also get to diversify across many other assets classes, like between stocks, between cash. Now you have bonds, such that when one class of an asset is not doing good, then you have a reprieve or some solace to find in the performance of another one. So it's important to note, don't carry all your eggs in one basket. And finally, also Treasury bonds carry with them what we call a high interest rate as compared to a bank savings account and even treasury bills. So I would invite you and challenge you to begin investing in bonds. And this you can only do by jumping into action, by fast opening the CDS account and saving enough to have the minimum investment, and then you'll be good to go. So thank you very much. I want to thank you for working with me in this journey, and for all those who have subscribed, thank you very much. For those who haven't, thank you for watching my videos, and I encourage you to subscribe, hit the notification bell, so anytime I post a video, you're able to get one, and kindly share with a friend if you think the information I'm sharing with you here is helpful. So thank you very much. Goodbye. See you later in future videos.